Today we're looking at an analysis of Beyond Meat, or BYND.
Right, framing it as a highly speculative meme stock opportunity for December 2025.
We have some key structural feedback to really sharpen its impact for traders.
So let's jump right in. The first thing that stood out to me was about, well, the core essence, how it handles the risk profile.
Exactly. It correctly flags the trade as extreme speculative, which is a great start. But the way it's structured kind of buries the lead.
So here's our first point.
The presentation of the extreme risk level needs to be structurally integrated earlier to better guide the high volatility trading audience.
I saw that immediately. The analysis flags the high risk up front, but then the most critical number, that absolute do-or-die support level, is saved for the conclusion.
Right. It's a huge gap. For a report aimed at traders trying to scalp 10–20% swings, making them wait for the exit strategy it guts the immediate utility.
It weakens the entire premise.
When you're pitching a momentum trade this risky, the first thing you have to define is the floor. The upside is just a theory.
Okay, but let me push back on that for a second. If you lead with the catastrophic failure point, that $1.15 level, don't you risk scaring people off before they even see the upside?
I don't think so. We shouldn't fear the risk. We should define the entire trade by it. That $1.15 number isn't about fear. It's about clarity.
Okay.
The whole thesis, the whole reason it could go to $1.70 or $2.70 is that the technical floor holds. If the floor is the thesis, it has to be front and center.
So the risk management isn't a footnote.
No, it's the price of admission for this trade.
That makes perfect sense. The strength of the play is completely tied to that immediate catastrophic risk. It's two sides of the same coin.
So the suggestion is pretty simple, really. Just resequence it. Take that critical risk threshold, the 1.15 number, and put it right after the initial meme stock setup in section 1.
You're framing the whole analysis around that tight risk-reward window?
You're telling the trader, look, here's the game, and here's your non-negotiable out.
So what would that look like in practice? Can you give me a concrete example of how you'd rewrite that?
Absolutely. You take the line, the do-or-die support of $1.15, $1.20 from the conclusion, and you stick it right at the end of section 1.
After the squeeze mechanics?
Right. So section 1 could end with something like, this squeeze potential relies entirely on the stock maintaining support above $1.15. If this floor breaks, the momentum thesis is instantly negated.
And the next stop could be sub $1.
Exactly. It triggers margin calls, forced selling. It's not a slow bleed, it's a cliff.
That integration makes the whole thing so much sharper. It connects the mechanics of the squeeze directly to the mechanics of failure.
Total focus for the target audience.
Okay, great. That's a powerful structural shift.
And it flows directly into our next point, which is about connecting sentiment to these technical levels.
Right, let's talk about structure and flow. The analysis does a good job trying to balance that ape optimism with the harsh fundamental reality.
It does, but the way it's laid out right now creates a kind of narrative bottleneck.
So the point is,
reformatting the bullish spin versus bearish reality comparison will improve the analytical flow and more directly tie market sentiment to the technical levels.
okay, let's drill down on that. You're talking about the comparison table in section 2. It's got the right data, debt, price targets, all that. But it does feel like you hit pause.
You do. You absolutely hit pause. It's a momentary halt in the narrative. You're going from this explosive short squeeze setup in section 1 to the key technicals in section 3. And stuck in the middle is this.
The static table.
Exactly. It disconnects the psychology, like the whole institutions are trapping bears idea, from the actual price point is supposed to influence, like the 140 breakout. The reader is left to connect the dots.
Explicitly link how the psychology drives the price action.
Right, it's like two separate analyses. So my suggestion is, I think we should just get rid of the table.
Get rid of it entirely?
Well, not the information in it. Scrap the table format. Instead, you integrate the most important points as direct commentary for the technical levels they support, or undermine.
So you show the functional link.
Yes, show why 140 matters. It matters because that's where the psychology forces shorts to physically start covering their positions.
That's way more efficient. It turns a list of facts into a justification for the price targets. You're basically making the chart feel like a battleground.
We are. You can't ignore narrative. So let's just walk through an example on the upside.
Yeah, please. How would that look for, say, that key resistance level?
Okay, so for the $1.45 breakout trigger, instead of just listing it, you could say something like, this ceiling represents the line where the ape narrative, the belief it can easily hit $3, forces short sellers, that's 21% of the float, to capitulate.
Fueling a run toward 170.
Exactly. You call it a psychological barrier as much as a technical one.
And that gives the technical level a layer of depth it was missing. So then you can do the reverse for the support level we just talked about.
You have to. You use the bearish reality data points, the debt, the delusion, to reinforce why that $1.15 floor is so incredibly fragile and so important.
You're showing that these aren't just lines on a chart.
They're the exact points where sentiment and reality are about to collide. It makes the whole report feel like one single cohesive argument.
That's a fantastic way to unify the piece. Okay, let's shift focus to the time-sensitive stuff, the recent news. Right, so let's look at completeness and focus. Specifically how the December catalysts are linked to the confusing price action right now.
Yeah, the report identifies a lot of recent negative news, which is good, but it feels detached from what the stock is doing day to day.
What's the takeaway here then?
The analysis should more explicitly connect the immediate December catalyst to the existing chop zone to maximize the sense of urgency and detail the volatility drivers.
I see. So the report correctly points out this $1.23 to $1.29 range as a chop zone, right, where traders are just getting chewed up.
It does, but then it lists the reasons why. The legal news, the CEO selling shares, tax loss harvesting, later in a separate section.
It's that same disconnection issue again.
It is. The analysis misses a huge opportunity to say, hey, these negative things are the reason for the chop. It's not random. If traders understand what's causing the sideways action, they can better anticipate how long this trap will last.
So the weakness is the separation between the observed price action and the events driving it.
Yes.
Let's clarify some jargon here for context. Tax loss harvesting. How is that specifically affecting this tight 1.23 range?
It's a huge deal because it's indiscriminate selling. It's investors locking in losses for tax purposes before year-end. They aren't selling on fundamentals or technicals, they're just selling.
Which creates an artificial ceiling.
A temporary one, yes, right at these low December levels. And the insight the analysis needs to provide is that this specific time-bound selling is what's confusing the market and creating the chop.
Understood. So the suggestion is to frame the discussion around those catalysts to show they are the engine of the current volatility. They confirm the trap environment before a potential January rally.
That is the essential insight. It gives the analysis a sense of real-time interpretation. It answers the question every trader is asking, why is it stuck right now?
And that kind of linkage just makes the whole thing feel so much more alive, more dynamic. It's not a list of facts. It's a coherent market thesis.
It is.
So how do we make that synthesis really clear in the writing?
We have to combine the data points directly within the description of the chop zone itself. You show how they converge.
Okay.
Something like the selling from tax loss harvesting through mid-December, plus the market misreading the CEO's routine surrender of 12,500 shares, and the new securities fraud investigations. These things together are precisely what's defining the volatility in the $1.23, $1.29 chop zone.
And you have to stress that these catalysts are what's holding the price down.
Yes, that they are actively preventing the squeeze from starting its run toward $1.40.
That's incredibly sharp and very actionable. It transforms the chop zone from just an observation into a temporary, event-driven phenomenon.
And it confirms for the trader that the market is in fact setting a trap, which validates the whole meme stock thesis to begin with.
It also helps them anticipate the timeline.
Right. Once that tax loss selling fades after mid-December, the setup for the squeeze becomes much, much clearer. It strengthens the conviction for a patient trader.